Every market cycle leaves behind companies priced for failure, despite balance sheets that quietly suggest survival. That disconnect, often highlighted quietly on platforms like Bloomberg and MarketWatch, is where disciplined investors tend to earn their returns, not through excitement, not through momentum, but through valuation and time. Today's discussion centers on one of those situations, a company trading near historic lows despite holding more cash than its entire market value suggests. This is not a momentum trade, it is a balance sheet-driven setup, with optionality mispriced by investor impatience. When I evaluate small-cap technology names, especially those outside institutional favor, I begin with one question: how long can the company fund itself without returning to shareholders for capital? That single number frames dilution risk, downside probability, and upside symmetry. The company we're discussing trades around $1.70 per share, yet the capital structure beneath that price deserves a closer look. This is a valuation conversation, not a product demonstration. And if you're watching for the kind of setup that could unlock a 3x path from a 1.7 tech penny stock, this is exactly that type of situation. Undervalued, overlooked, and waiting for the market to catch up. Before we begin, welcome to KMI. This channel focuses on disciplined, numbers-driven analysis of emerging technologies and U.S. market opportunities, with an emphasis on valuation, balance sheets, and risk. The company is Nano Dimension Limited, ticker NNDM, listed on NASDAQ. It operates within advanced manufacturing and additive electronics, a space dominated at the high end by names like HP and General Electric. Those are well-capitalized incumbents with scale, distribution, and mature margins. Nano Dimension is not competing on size. It is competing on niche capability, while sitting on a balance sheet most peers would envy. This is not a traditional growth stock today. It is better understood as a capital preservation first situation, with embedded optional upside. For experienced investors, this is about sizing, patience, and probability, not excitement. Let's anchor everything in numbers, because numbers are what create conviction. At a share price near $1.70, Nano Dimension carries a market capitalization of roughly $450 million. Shares outstanding are approximately 265 million, reflecting multiple equity raises over prior years. That dilution history matters, and it should not be ignored. As SEC filings clearly show, dilution risk must always be evaluated relative to liquidity. As of the most recent disclosures, Nano Dimension holds approximately $900 million in cash and equivalents. That means the company is trading at roughly 0.5 times its cash value. Another way to frame that, enterprise value is effectively negative, and that single fact, often highlighted in valuation screens on Bloomberg terminals, reframes the entire downside discussion. Revenue performance has been uneven, and it's important to be direct about that. Trailing 12-month revenue stands around $55 to $60 million based on data from NASDAQ.com and company reports. That represents a year-over-year decline of roughly 15 to 20%. The decline stems primarily from divestments and a pause in acquisition-led expansion. Quarterly revenue averages $14 to $15 million. That figure must always be compared against cash burn. Gross margins currently sit in the 30 to 35% range. That is meaningfully below peers like Stratasys and 3D Systems, which operate closer to the mid-40% range. Operating margins remain deeply negative, around minus 90%. Net margins reflect similar pressure, as fixed costs outweigh current scale. Earnings per share remain negative, though the trend shows gradual improvement. Annual losses have narrowed from approximately minus 60 cents per share to closer to minus 40 cents, according to consensus data tracked by Yahoo Finance. That improvement reflects cost containment, not revenue acceleration. And at this stage, that distinction matters. Returns on equity and assets are predictably negative. Return on equity sits near minus 10%. Return on assets near minus 8%. However, both are distorted by the size of the cash balance. This is not a leveraged balance sheet absorbing losses. It is a liquid one, unlike many smaller competitors that rely on debt or frequent equity issuance. Free cash flow remains negative, running approximately minus $100 to minus $120 million annually. That translates to roughly minus $25 to minus $30 million per quarter. That number, repeated intentionally, defines risk. Now, this is where the thesis either stabilizes or collapses. With approximately $900 million in cash and a quarterly burn of $25 to $30 million, Nano Dimension has more than 30 quarters of runway. That is 7 to 8 years, at the current pace. Debt levels are minimal. Total debt is under $40 million. The debt-to-equity ratio sits near 5%. The current ratio exceeds 10 times. From a balance sheet perspective, this is exceptionally strong. Because of that, near-term dilution risk is low. Based purely on burn rate, dilution probability over the next 24 to 36 months is minimal. That sharply separates Nano Dimension from many sub-$1 billion peers, including smaller additive players that routinely issue stock to survive. Institutional ownership stands near 20 to 25%. Insider ownership is approximately 8 to 10%. That suggests alignment without excessive control. Now let's talk about growth quality, because growth without visibility does not deserve a premium, a principle often reinforced in Wall Street Journal analysis. Management is not guiding toward aggressive revenue expansion. Instead, the focus has shifted toward portfolio rationalization and capital discipline. Recurring revenue is estimated near 40 to 45%, driven by services and consumables. Customer concentration remains manageable, with no single customer exceeding 10% of revenue. That contrasts favorably with smaller competitors that rely on a handful of industrial clients. Any future growth must be margin accretive. At current scale, revenue growth without margin expansion only extends losses. That would not create shareholder value. Valuation is where this story becomes underappreciated. At current revenue levels, Nano Dimension trades around 7 to 8 times sales. On the surface, that appears elevated, but valuation must be framed through enterprise value. On an EV to revenue basis, the multiple is effectively below 0 times. Peers like Stratasys, 3D Systems, and HP's additive division trade between 2 to 4 times EV to revenue, often with thinner cash cushions and higher leverage. Price-to-earnings ratios are not meaningful today. Forward PE becomes relevant only once profitability visibility improves. EV to EBITDA also lacks relevance at this stage, but normalization scenarios still matter. If Nano Dimension simply trades to 1.0 times cash value, with no operational improvement, the implied share price is approximately $3.40. That represents nearly 100% upside, purely from valuation normalization. Catalysts must change financial outcomes, not sentiment. The first catalyst is cost discipline. Every $10 million removed from annual burn STUP extends runway by roughly 4 quarters and reduces dilution probability. Second, capital deployment. If even $200 million of cash is deployed accretively through buybacks or disciplined acquisitions, per-share value changes materially, a dynamic often discussed by capital allocation specialists on CNBC. Third, margin stabilization. Moving gross margins from 35% to 45% adds roughly $6 million annually at current revenue levels. That begins to close the gap with larger peers. Fourth, strategic optionality. At this cash level, Nano Dimension becomes a potential platform or acquisition candidate for larger industrial players like HP, Siemens, or GE. That optionality is not reflected in today's price. Now let's frame outcomes probabilistically. In a bear case, cash burn persists, revenue stagnates, and valuation remains compressed. Shares drift toward $1.20 to $1.30. That implies 25 to 30% downside with low bankruptcy risk. In a base case, burn moderates, capital discipline improves, and valuation normalizes to cash. Shares move toward $3 to $3.50 over the next 24 months. Probability assigned, 50%. In a bull case, margin recovery occurs, and capital is deployed effectively. Valuation moves to 1.5 times cash. That implies $4.50 to $5 per share. Probability assigned, 20%. The probability-weighted outcome centers near $3.20. That represents roughly 90% upside from current levels. Risks must be acknowledged clearly. The primary risk is capital misallocation. Poor acquisitions would destroy value. Another risk is prolonged margin erosion, which would extend losses unnecessarily. Execution sensitivity remains high. This is not passive capital. That said, bankruptcy risk remains extremely low. Capital loss is possible, but asymmetrically framed by balance sheet strength. Let's close by summarizing what matters. Nano Dimension trades near $1.70. It holds approximately $900 million in cash. Debt is minimal. Runway spans multiple years. This is not a rapid growth story. It is a valuation-supported setup with optional upside. For a diversified portfolio, the question is not conviction, but allocation. Does this justify a 1 to 3% position within a long-term framework? Is the balance sheet strong enough for your time horizon? Does the risk-reward justify patience? Those are the right questions. The numbers tell the story. That's what matters. See you in the next one.